Welcome back to the Deep Dive. Our mission today is pretty laser-focused, actually. We're cutting through the latest regulatory filings, press releases too, for Moschip Technologies Limited.
That's right.
We're deep diving into their Q2 and H1 results for this fiscal year, FY26. It's a really critical time for them, being in semiconductor and product engineering solutions.
Yeah.
Okay, let's unpack this.
And we've got quite a stack here. Unaudited consolidated financials, standalone too, detailed governance updates, and maybe most importantly, their own commentary on strategy, especially with the, red-hot semiconductor market.
Right.
So if you need a fast but thorough understanding of where Moschip stands right now, their performance, their direction, this deep dive should give you exactly that.
Good.
And, just to kick things off at the big headline number, the most dramatic figure we pulled out was that huge 68% surge in net profit after tax. Consolidated for the first half, H1 FY26.
68%. Wow. Year-over-year profit growth. That's not just strong. That's exceptional, isn't it?
It really is.
So we're looking at the 6 months ending September 30th, 2025, compared to the same time last year. That kind of margin jump, it suggests something fundamental shifted, right? Either in their business or maybe market conditions.
Yeah.
What drove that?
Well, it looks like a combination, really. Aggressive revenue growth, definitely, but also paired with better efficiency. Looking at those consolidated H1 numbers, revenue from operations grew by a solid 37%.
37%, okay.
Yeah, we're talking about a jump from around 206 crores to 282 crores. Just for context, a crore is 10 million rupees, about 100 lakhs. So that shows real commercial success.
That 37% top-line growth is pretty substantial on its own, for sure.
Absolutely it is. But like you said, when the net profit jumps almost twice as fast as revenue, well, that's where the story gets really interesting. EBITDA earnings before interest, tax, depreciation, amortization, that grew strongly too by 31%. But the bottom line, net profit after tax, hit 23.05 crores. That's up from 13.71 crores. What's fascinating here is the corresponding leap in diluted earnings per share, the EPS. That's the metric shareholders really watch.
Right.
It essentially doubled, rose to 1.14 for H1 FY26, up from 0.69 in H1 FY25.
That really paints a powerful picture, doesn't it? Sustained momentum over the last year. And in an industry like semiconductor design, which can be so competitive, cyclical, knowing this isn't just a one-quarter blip, but a trend over 6 months, showing growth across all those efficiency metrics, that's vital for understanding their valuation.
Exactly.
The big question, though, is always sustainability. Can they keep up a 68% profit growth pace?
Well, that's where the quarterly performance gives us clues. The half year shows the trend, right? But the quarterly numbers show the current velocity. And Moschip kept up solid momentum just in the second quarter, Q2 FY26.
Okay, so how did that sequential movement look, comparing Q2 to Q1 this year?
They stepped forward pretty much across the board. Revenue from operations was up sequentially by 8%, climbed from about 135.59 crores in Q1 to 146.94 crores in Q2.
Right.
And crucially, the bottom line improved faster than the top line again. Consolidated net profit after tax, up 12% sequentially for the quarter. Moved from 10.90 crores to 12.15 crores.
Okay, so we have sequential growth showing things are moving forward positively.
Yeah.
And if we compare Q2 this year to Q2 last year, the standard year-over-year view.
Yeah, that looked healthy too.
Revenue growth was 17% and net profit growth was 25%. So it seems like the company's showing healthy compounding growth, whichever way you slice it.
Precisely. They are accelerating. And, when a company accelerates this fast, it often means they need to make changes, strategically, governance-wise, just to manage that new scale.
Right, yeah. Good point. So transitioning from the raw numbers to the people, the structures guiding the ship, what did the sources tell us about governance? Any employee actions during this high-growth phase? Here's where it gets really interesting.
Well, the Q1 filing confirmed a resignation. A non-executive director, Mr. Naveed Ahmed Sherwani, left back in June 2025.
Okay.
But maybe more significantly, the board moved fast to beef up its independent oversight. They approved appointing 2 new additional directors, both as independent directors, for 5-year terms.
Right. And those were Mr. Sandeep Himatlal Shah and Dr. Yelamanjali Srinivas Rao. Starting late October 2025, pending shareholder approval, of course.
Right.
So swapping out one director, bringing in 2 new independents right in the middle of this massive growth. It kind of suggests the board's really focused on oversight, maybe strategic guidance,
Yeah.
gearing up for bigger things, larger contracts, maybe global expansion.
Exactly. It looks like an active adjustment to match that increased financial complexity. And you see that proactive stance in their talent management, too, specifically with employee stock options, ESOPs.
Ah, ESOPs, the classic way to keep key people invested, motivated for the long term. What was happening there?
Quite a bit of activity in the first half, actually. In Q1, the board granted over 17 lakhs. That's about 1.7 million ESOPs to eligible employees. So new long-term incentives, basically.
Okay.
Then, by the Q2 update, we see over 1.37 lakh equity shares were actually allotted when people exercise their vested options.
Okay.
So that shows two things, right? One, they're committed to bringing new talent into the ownership structure. And two, existing staff are cashing in, suggesting maybe they feel pretty confident about the company's future stock value.
That's a neat link from the big financials down to practical people management. Okay, now let's turn to the business segments, because to really get why profit jumped 68%, we need to dissect what they're actually selling. What drove that margin expansion?
Right. Well, first thing to note, there was a bit of an organizational clarity tweak recently. The group changed the segment names. Seems like it's to align better with, modern industry terms. Semicon is now Silicon Engineering Solutions.
Okay, Silicon Engineering Solutions.
And Software and System Design is now Product Engineering Solutions.
That distinction feels important. Can you break down the strategic difference between those two for us? What's the core focus of each?
Certainly. Think of Silicon Engineering Solutions as the really deep tech, high-value work. This is where they're designing the actual core components, the ASICs, the FPGAs, the complex intellectual property, the IP that goes inside the chips.
Got it. The core brain, so to speak.
Exactly. That kind of engineering needs highly specialized talent, and it commands premium, high-margin pricing. Then you have Product Engineering Solutions. That's more the integration layer, developing system software, running verification, basically integrating those silicon components into a final product ready for market, like an IoT device or part of a telecom system. Still vital work, but often a bit lower margin than designing the core IP itself.
Okay, that makes the value chain much clearer. So when we look at the consolidated segment revenue for H1 FY26, those numbers suddenly make a lot more sense, especially with that 68% profit growth.
They absolutely do. The Silicon Engineering Solutions segment, the high-margin one, brought in roughly 220 crores in the half year. Wow, okay.
Product Engineering Solutions, while still significant, was much smaller, just over 61 crores. So Silicon Engineering is clearly the dominant financial driver here. That segment contributed way, way more to the overall segment results, the profit before interest and tax for the half year. So the incredible profit jump is really directly tied to the market demanding their highest margin, most specialized service, the design and IP side. That explains those high efficiency ratios we saw earlier.
Exactly right. The company is successfully commanding higher prices for its specialized design work. That's textbook operating leverage in a tech company. Now, let's connect this to the balance sheet for a second, because rapid growth, while great, always creates pressure points somewhere.
Right. And a quick look at the unaudited consolidated balance sheet as of September 30, 2025. Yeah, it shows a pretty noticeable change in their asset profile. That's where you see that pressure.
Yes. Total assets increased substantially, over 538 crores now, up from 443 crores at the end of March 2025. But the real driver behind that overall asset increase, a dramatic jump in trade receivables.
Ah, the money clients owe them.
Precisely. Money owed for services already rendered, it nearly doubled. Rose from 88 crores at the fiscal year end to almost 175 crores at the half-year mark.
That's a huge spike in receivables, almost double the pending payments. Is that a red flag for cash flow, or just the natural result of finishing and invoicing a ton of those high-value silicon engineering contracts?
It's a really important question. Usually in this industry, it's the latter, but it definitely needs watching. It means while sales volumes have shot up, you see that in the 37% revenue jump, the cash collection cycle for those big projects is lagging a bit behind, which is pretty typical for long-term design contracts.
Okay.
It suggests really robust, high-volume sales, definitely, but the company needs strong working capital management to bridge that gap until the invoices get paid. It confirms just how big their recent sales success has been.
So strong financials, driven by that dominant high-margin segment. The balance sheet reflects the sheer volume of work. How is the company translating that success into future capacity? They must be investing, right?
Oh, they're definitely not sitting still. The sources point to a clear operational expansion strategy. Moschip is actively expanding its physical footprint in India, moving into bigger, strategically chosen offices in both Bangalore and Pune.
Right, the heart of India's tech sector.
Yeah.
Key locations.
Precisely. And this expansion is explicitly to support growing business needs, improve employee convenience, which is critical for keeping that specialized talent, and ultimately to support continued growth in both their silicon and product engineering areas. They're literally building the capacity to handle the work suggested by that huge trade receivables number.
And this expansion is happening against a pretty incredible macro backdrop. If we connect this to the bigger picture, I mean, the massive projected growth in the global semiconductor market, that really gives the context for why Moschip is expanding so aggressively now. They're not just reacting, they're gearing up.
The context is frankly staggering. Our sources show the global semiconductor market size is projected to grow from about USD 755 billion this year to over USD 2 trillion by 2032.
2 trillion, wow.
Yeah, that's a compound annual growth rate, a CAGR, of 15.4% over that period. The market is set to more than double in size. It's huge.
And given their business, highly specialized, localized expertise, but serving global needs, their location in India is a major advantage, isn't it?
Absolutely. The Asia-Pacific region already holds over 50.94% of that massive market share as of 2024. That just underscores the strategic importance of Moschip operating within India. And the U.S. market is also expected to hit USD 258 billion by 2032, driven by consumer electronics, complex IC integration, exactly the stuff Moschip does.
Right. And Moschip seems perfectly positioned to grab a piece of that growth. Their core offerings list things like ASIC design, FPGA development, IoT, AML acceleration, verification services, and they mention key verticals like automotive, telecom, healthcare, all expanding rapidly. They're like specialized guides in an exploding market.
Yeah, their whole strategy reinforcing governance, expanding physically in India, focusing on that high-margin silicon engineering, it looks like a direct strategic response to that massive opportunity, that 15.4% CAGR. They're clearly betting big on the future of specialized chip design.
So just to sum up what we've unpacked for you today. Moschip delivered exceptional H1 profit growth, 68% year over year. That was supported by strong sequential quarterly performance, too.
And that profit growth seems largely driven by their dominant, high-margin silicon engineering solutions segment.
Right. And on the strategic side, you've got new independent directors strengthening governance, and they're actively investing in future capacity. Big physical expansion in Pune and Bangalore.
While also managing that substantial increase in trade receivables, which, really points to booming sales volume right now.
Okay, which leads us to our final thought for you to chew on. Considering Moschip's focused expansion in Pune and Bangalore, and this immense projected growth in the global and especially Asia-Pacific semiconductor market, how effectively can a company specializing in both that high-margin silicon design and product integration capitalize on the need for digital and product transformation across industries like automotive, health, telecom, especially in an industry poised to more than double by 2032?
Yeah, something to watch is how well they manage that cash collection cycle against that incredible 68% growth rate. It's a high-class problem, but one to keep an eye on.